Yeah, thanks for having me. And so here at Allspring on my multi-asset team, we actually think that we could probably retest the lows that we saw back in June. That'll be very important to see whether or not we can hold that level or not, because obviously if you don't, you go lower, almost by definition, right? But if we don't actually find support at around that 3640 or 3666 level, we think that it could actually be a rather quick retreat down to 3400. So across our book here on my multi-asset team, we actually have quite a few more defensive trades because we think that this downdraft is likely to be fairly short-lived. So even though it might be rather nasty, hopefully it's going to be rather short.
Brian, what are you expecting to hear from Powell tomorrow?
The interesting thing, at least from an economist's perspective, is that given that this is the September meeting, we actually get one more year's worth of information in the summary of economic projections. They typically show you the current year, next 2 years, and long term. Well, now we're going to have the 2025 numbers in there. So a total of the 4 years and then plus the long term ones. What we're expecting to see is that the Fed wants to signal they want to hike up to about 4.5% and then hold there for the duration of 2023, and then maybe begin to taper down that federal funds rate towards something that more longer trend growth, or that longer trend number of about 2.5%.
Brian, obviously a 100-point hike would shock the markets. I think there's a 25% chance currently baked in. What could the Fed chair say that really shocks the market?
Well, I think that actually you're right. If they do that 100 basis point, that would be a big shock. Chair Powell said that 75 basis points is unusual. 100 basis points would be extraordinary. And I don't think that we're in extraordinary situations right now that would require a 100 basis point hike. Keep in mind that monetary policy operates with lags, and those lags are measured in terms of quarters, if not years. In the past, recessions have happened about, on average, 30 months after the first rate hike. So that's over 2.5 years after the first hike. So, the pace that they're going at now is a little unusual. And I think that Chair Powell isn't really going to want to almost like out-hawk what the market is already pricing in.
And we're obviously seeing other central banks raising interest rates as well, trying to really rein in inflation globally. And you're saying that you actually like emerging markets as a long-term play. Why is that?
One of the reasons why here on our multi-asset team that we actually like emerging markets is because they were ahead of the Fed when it came to hiking rates. In the past, a lot of the emerging market turmoil really happened after Fed rate hikes because those economies were rather slow to adjust to that rising rate environment, and you saw capital flowing out of those countries. Well, this time, they're actually ahead of the curve when it came to hiking rates. So we think that this situation is sufficiently different from past episodes where there could be maybe a little bit of relative stability in some emerging markets. And if anything, one of the things that we really like about emerging markets is more for that longer term play. Maybe we're early with liking emerging markets, but the valuations relative to what we have here in the United States and relative to their historical averages seem pretty compelling to us right now.
Hey, Brian, I want to bring up what's happening here in the U.S. because Atlanta Fed, the latest estimate out there in terms of third quarter GDP, they're now expecting GDP to grow at 0.3%. That's down from what they were initially seeing of around 0.5 percentage point climb. The estimates, though, keep dropping. Do you think we could see potentially negative growth here in the third quarter?
We don't think that we're going to see a negative number in the third quarter. The big swing factor is going to be inventories. And given that we had a big drag from the inventory number in the first and the second quarter, those tend to unwind themselves in subsequent quarters. So if anything, maybe there might be some superficial strength in the third quarter number, keeping it positive, mainly due to that inventory swing number. What we like to do track is the gross domestic income instead of gross domestic product. And that's just kind of a different way of looking at the same coin. It's about, are you looking at what's produced or at the income that's generated based off of selling what's been produced? And that GDI, or gross domestic income number, has been more positive and a little bit more stable. And we think that that's perhaps a bit more indicative of the underlying trend, which unfortunately is still downwards, but not yet negative.
Brian, you talked about the likelihood of new lows, at least for the S&P. Searching for some silver lining here. What could be the catalyst that turns things around for equities here?
Yeah, it's very rarely that you have an economist trying to find the silver lining behind every cloud. We usually point out the cloud behind the silver lining instead. But I do think that the silver lining is that now that rates have reset higher, you can get some decent income off of fixed income. And we actually, within the equity space, really do still like small cap value that is especially dividend paying companies that can provide a little bit more ballast and stability to the portfolio, especially since it looks like from a valuation perspective, those parts corrected a long time ago. They've underperformed the large cap growth space for a number of years. And we think that perhaps this is setting the stage for a number of years of outperformance of those types of styles that were more not in fashion during the past economic and market recovery.
And Brian, for people who are tempted to buy the dip, what should they be aware of? What are some of the nuances that you're keeping an eye on?
Yeah, when it comes to trying to buy the dip, that's a very difficult thing to do. We don't try to buy the dip. Ideally you could, but we understand that we can't. And so to hedge your hubris in terms of thinking whether or not you can time it, that's where some of those simple techniques of like dollar cost averaging can make a lot of sense. Like, for example, on a day like today, now that the market is down more than 1% ahead of the Fed meeting, I think this is actually somewhat encouraging because it shows that the market doesn't have very high expectations of what they expect to hear from the Fed. And those low expectations going in, maybe that sets the foundation for the possibility of an upside surprise. If the Chair Powell maybe sounds a little bit less hawkish than what people are fearing, you could see a decent rebound. And so instead of trying to get caught flat-footed or over your skis or whatever, bad analogy I can come up with, just those simple rules of decent valuations, dollar cost average in, and maintain that longer term perspective, because from a valuation perspective, smaller cap, value, emerging markets, seems like if you have a 3 to 5 year horizon, not a bad place to be.
All right, Allspring Global Investments senior investment strategist Brian Jacobsen, thanks so much for joining us.